Right now, and I think for the foreseeable future, we are in this somewhat sweet spot where softer employment's allowing interest rates to decline, allowing the Fed to cut slowly and steadily. And that is starting to show up in both forward-looking data sets that forecast housing PMIs or orders and profits. And I think is already starting to show up in some better housing data, which tends to be the most rate sensitive part of the economy. So, it's kind of a no pain, no gain backdrop, if you will. And I think that's particular to this environment after the 22 inflation shock. And while it is uncommon in the last 30 years, if you go back 60 years, it's actually happened quite often. So it's not unprecedented.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Folks, we are very lucky to be joined today by Michael Kantrowitz, Chief Investment Strategist and Managing Director at Piper Sandler. I think it's a very opportune time to have Michael on. Michael is best known for his H.O.P.E framework, which is a highly effective way to measure the health of the economy and to tell whether it's getting stronger or weaker. As we approach the end of the year here, 2025, there's a lot of uncertainty heading into 2026. There's a lot of cross currents going on. And I think being able to look through his lens, being able to look through his framework, gives us a really good sense of where things actually stand right now and on a net basis, where things are trending. So anyways, Michael, thanks so much for joining us today.
Yeah, always a pleasure, Adam. Good to see you.
Good to see you too. Look, lots to talk about. And if we can, I have you do this every time you come on, but if you can just give, perhaps 30 to 60 seconds in terms of background on this, which is kind of the hero visual for your H.O.P.E framework. Just explain what it is and why it's so effective for you as a lens to look at the economy through.
Sure. So the H.O.P.E framework, as you can see, the acronym is Housing, Orders, Profits, Employment. And it was an analysis I did many years ago, that I was looking at the impact of changes in interest rates, specifically Fed policy, and how different popular leading, coincident, lagging economic indicators reacted to that through history, which goes back to about the 50s. And the results, not surprising, started off with your early cyclical sectors like housing, which has historically been always the first data set to begin to improve before a broadening recovery in the economy or just a broadening in general, followed by orders, which I look at a lot of PMI data, which stands for Purchasing Managers Indicators. So there's services and manufacturing. And when you get those two data sets to improve or deteriorate, it more often than not correlates to a change in the profits picture, whether or not profits are growing or slowing, and whether they're broad or narrow. And then, of course, whether we go into a economic contraction is generally a function of the employment backdrop. And so having this framework helps me understand, A, what's going on, keeps me honest, and helps me communicate a roadmap, particularly when the Fed is in a tightening or easing cycle, to point to different metrics in the macro data that I am looking for to either corroborate a view or to perhaps change my view. So yeah, we're at an interesting time now because with the weak employment, softer employment data of the last several months, employment has once again, it seems like we were at this point a year ago as well, become the focus of many investors.
Okay, yeah, and we'll get into it, and I know you've got a whole bunch of slides that'll give us the true picture. But I mentioned sort of cross currents earlier. Housing has languished. Employment was strong, but now looking weak. Profits have been generally pretty strong, but then tariffs kind of threw some curveballs earlier this year. So there's just a lot sort of swirling around here. So I'm really looking forward to just getting into the details of your latest data here. But I guess before you pull up any particular charts, if you just had to sort of summarize at a very high level your general sense of the economy right now, how would you describe it?
And this will be fun and controversial for your listeners. I would call it the Goldilocks backdrop.
Hmm.
And, I think it's the Goldilocks idea, I think, is generally viewed through the inflation lens predominantly. Good growth, low inflation, which is, of course, a great backdrop for equities. Though I think there's a nuance that we've all experienced and seeing play out in markets in a post-inflation shock world. So the 2022 inflation shock, which has made a Goldilocks, changed the definition, if you will, or added to it. And in this case, I call it Goldilocks because yes, we have softer employment data, and this is coming after a period of rising interest rates, rising inflation that have more often than not been the problem for equities, whether it was a point in 23 where higher rates, or in 22 pushed the market down broadly, or for the last 3 years led to a very bifurcated market. That we have a big bifurcation in the stock market. Obviously, on the top of that bifurcation is AI. But when you look at those sectors and stocks and parts of the economy that have lagged, there are a lot of reasons for that, but I think interest rates is number one. So ironically, softer employment, which I have thought it has been needed to get down interest rates, is a positive for both the economy and equities today. Of course, to a point. If we get negative 200,000 payroll data and unemployment goes up to 5.5%, that's too much of that. But right now, and I think for the foreseeable future, we are in this somewhat sweet spot where softer employment's allowing interest rates to decline, allowing the Fed to cut slowly and steadily. And that is starting to show up in both forward-looking data sets that forecast housing PMIs, or orders and profits. And I think is already starting to show up in some better housing data, which tends to be the most rate sensitive part of the economy. So, it's kind of a no pain, no gain backdrop, if you will. And I think that's particular to this environment after the 22 inflation shock. And while it is uncommon in the last 30 years, if you go back 60 years, it's actually happened quite often. So it's not unprecedented.
Okay, really interesting. I wasn't expecting the term Goldilocks, so that was a surprise. But I understand sort of how you're defining it here. Let me ask you a couple quick questions. One is, according to your framework, I mean, we've been talking for several years now, Michael, and the H.O.P.E framework really shows how an economy either falls into recession or gets out of recession. And it's the same progression in either way, housing first and then all the way through to employment.
Yeah.
Your framework says that we did not enter recession over the past couple of years, right? I mean, I know coming in 2022, everybody thought we were going to by the end of that year, early 2023. But I just want to clarify, your system did not say we entered recession, correct?
I would say, I guess, two responses to that. One, I think it's the word recession is thrown around so much, so often, and I think that means different things to different people. And obviously, nobody's trading recession. There's no binary contract on whether the U.S. goes into recession, and so we have to define what that means.
Mhm.
To me, it means a broad-based contraction in the economy, and we have factually not seen that.
Okay, so we've not seen that. Okay, so we did not have recession coming out of COVID. We avoided recession.
Well, we had
Um,
a, we had a recession in COVID, I guess, if
we,
you want
we,
to call
we
it
we
for
had the COVID
yeah,
recession, the
yeah, the
blink and you miss
shutdown.
it recession in
Yeah,
2020, right? But I'm saying after everything that went on during COVID, afterwards, we
yeah,
have not fallen back into recession. So we sort of,
no,
what I'm trying to say is we kind of dodged that bullet, right? The economy didn't go
thus far.
into
Yep,
recession.
yep,
And then secondly, coming out of 2022, we've had back to back to back kind of blockbuster years for equities,
yep.
right? double-digit
Abs-
gains, 220 plus, and then we're going to find out this year, but
Yeah.
we're already where, like 14% or so, something for that
Yeah.
this year?
It's crazy. We've had, I think since 2019, I don't have the numbers on top of my head, but we've had a 20% move every year in the market down in 22
Hmm.
since I think 2019. Either intra-year or for the, most of those years of the calendar year, which is not very typical. Like it's been this kind of boom, mostly boom, fortunately, and otherwise bust in 2022 backdrop for the markets. Like we haven't had a year where like the market grinded out 5% in a long time, which, does happen quite often.
Yeah, it's funny. Everybody looks at that as the average and think that's what you're going to get, but we're getting
Yeah.
all over the map. So I guess the reason I was trying to set all that up is
Yeah.
I think there are a lot of people who would say, really? God, we had this massive we shut down the world. We had all this crazy stuff going on. Everybody thought we were going to have a recession in 2022, but we didn't. We've had 3 amazing years since. And then it sounds like you're saying, and the party looks like it's going to continue. Looks like maybe the economy is actually starting to strengthen here. Don't let me put words in your mouth, but I kind of took that vibe from you. Maybe not barn burner, strengthen, but positive direction. And things look really good for equities in terms of this Goldilocks setup that you just mentioned.
Yeah, and to me, it's more about we're finally seeing the seeds of a sustained broadening in both the macro and micro backdrop. So it's really, think of like a quadrant or a matrix, and you have got on one axis you've got strength or magnitude, and on the other axis you've got breadth. So if you think about, for a good part of the last 3 years, we had a very strong market, but we had fairly weak breadth. So I would say what I see looking ahead is acknowledging we had a very strong market and valuations are high, credit spreads are low, and there's not a lot of risk priced into markets today. What I see is not necessarily a market that's going to continue to boom, because for that to happen, I think you need to continue seeing multiple expansion. And I think we're kind of long in the tooth of that story. But I do see earnings, the conditions for earnings to start broadening out. So I think you'll see a market that is not as strongly led by the top 10 largest stocks or just large cap growth, which we have seen some of that recent months. What I believe is that we're finally getting to a point where it can be sustained. This is the sixth rally where small caps have outperformed large caps since 2023, and on average they only lasted 30 days. And the reason, in my opinion, why they didn't sustain, because the whole rally took place because you got some macro relief, inflation came down, the Fed was going to start cutting or stop hiking, or we got a soft labor market, and it just didn't sustain itself because the earnings picture never changed for small caps. You just had this gargantuan gap between mega cap earnings and which were rising and small caps which were flat or falling. And we have seen that changed in the last 2.5 months. This is the broadest improvement in earnings we've seen really since 2021. And I think it can be sustainable finally. But again, I want to make sure this is not a binary conversation. It's not like all boom or bust. There's shades of gray in the middle. It'd be convenient if everything was that black and white, but we certainly see a backdrop where we're going to see more competition from the largest companies. And I think that has a lot to do with actually softer employment.
Okay, so it sounds like what I hear you say is you expect the market to become less bifurcated, meaning
Yeah.
the bottom part, which had really been getting left behind, you think is starting to heal and get a bit stronger. So when you say Goldilocks, then a Goldilocks backdrop for the markets, then maybe you're not necessarily saying, hey, I expect the S&P to like leap forward from here, continuing to be propelled by the high growth, the mega growth companies. Presumably we could kind of go sideways for a while but this bottom half could do very well. So is it more of a rotation that you see where capital is actually coming out of richly valued mega caps and going more into the other parts of the market, or no? Do you see growth in everything going forward?
Yeah, I think there's, again, I like the term broadening. Rotation, I think we have to be careful with because I still think the secular tech story is quite strong. Yes, there are very big expectations built in some stocks, very high elevated valuations. And one day that may end. I just don't think that day is today. So I think it's really from the bottom part of, if we look at this as a K-shaped economy, I think we're beginning to see some healing in specifically some of the more leading aspects of that can represent that bottom part of the economy. So even in housing, do I expect home prices to move higher? No, not really. In fact, they'll probably fall. But do I expect permits and refis and sales data and permits? I already said permits, applications to start improving or continue improving, I would argue, in some cases. Yeah. I think in summary, I can really simplify it. I think employment's going to remain soft and it's going to allow rates to come down. And that's going to allow housing to start healing in some of the leading indicators of housing. And similarly for manufacturing activity, I don't think it's going to be a V-shaped boom, but I think it's going to be a healing. When I look at the housing and manufacturing data, it's really been an L-shaped story for the last few years. We haven't seen this broad-based sustained decline in housing activity. It's really kind of hit a bottom in some cases. Like we look at total home sales, like it's hard for them to really go much below, 4.5 million annualized. So I think we're starting to see we're coming out of that a bit. So again, a slow and steady broadening, not a V shape, but I think we finally have those conditions where that can be sustainable, recognized, and would give investors a reason to say, okay, I'm not going to just buy small caps because I think the Fed's going to cut, but now I'm actually starting to see some improvement in earnings expectations in some of these companies that have been drastically lagging for many years.
Okay, that's very useful. So in terms of the bottom part of the market and the economy doing better, let's talk about the market for a moment. When you say bottom, like, are you talking about the small caps? Are you talking about the Russell, or are you talking like about the S&P 493? Like,
Well, I think all of it, but there's a couple, I think, important nuances that I think are really worth acknowledging. So typically, your best backdrop for small caps is, after a big market downturn where they get crushed. So we kind of saw that in March and April. And so you get a rebound in equity, investors jump into risk. Those are only sustained if you have follow through from earnings. So they tend to be driven initially by multiple expansion and macro relief, and then they can continue if the earnings picture is persisting. So you tend to see that coming out of a recession where everything broadly goes down. So that's not been the backdrop. But we, of course, have had this big rebound since the pause in tariffs in early April. So when I think about small caps, we don't have the best environment for them, which is what I just explained, but we do have a better environment for them. And I think if we look back at the last 5 months and say, okay, well, predominantly what drove the whole market higher was PEs re-expanding, or kind of risks and uncertainty coming back down. And you could see this in data. Credit spreads are near all-time lows, which is corroborating why PEs are back to very high levels, whether you look at small caps or large caps. So that kind of part of the story is, I think, a bit played out already. In the last 2 months, why I think small caps have really taken over is because they saw the benefit of macro relief, which everything kind of benefited from that rising tide. And we've seen an improvement in earnings expectations there for a lot of reasons. So when I think about going forward and say, okay, well, if there's two catalysts to stocks going up, it's PE expansion and better earnings. It is that simple. I think the burden is going to be on the earnings story. And we've kind of used a lot of the fuel up in the macro or PE expansion part of the story. So I don't think it's a blindly go buy small caps because we're all worried about something or the market's worried about something and that worry is going to go away. That's what's happened over the last 5 months. From here, you got to deliver on earnings. So I don't think we're going to see a strong enough economy coming out of this. Or even when I'm talking about breadth, I don't think housing is going to do a V shape or PMIs are going to be in the high 60s anytime soon. So given that, I think it's kind of a more of a slow and steady healing, which is, I think, again, a big deal. I don't think it's going to be a boom. And so I think you're going to have to be still selective. But yeah, I think there's going to be more of a diversified return set from the market going forward, and smaller companies will benefit. Cyclical sectors, I think, will continue to benefit. And I think large cap tech is going to do fine. But I think where the biggest rates of change are happening are going to be outside of mega cap tech.
Got it. Okay. So don't let me put these words in your mouth if they're incorrect, but uh, it sounds like sort of an active investment strategy is probably going to, in your opinion, have a higher likelihood of doing better going forward than sort of the passive, just buy the indices and ride them. Because to your point here, it may not be a generalized boom here, but you'll see pockets of the market outperform as those parts of the economy start to heal more.
Yeah, I mean, we've been really in a growth-driven stock market. I mean, really, you can go back to 2007 was the peak of value leadership going back 100 years. And value-led markets are much better for active managers because they tend to be broader. And growth-led markets, if we think back to Mag 7 the last few years, even 10 years prior to today, you think of FANG, and even going back to the kind of GFC mark, it's generally been a very large growth driven market, which is for active managers, it's hard to beat because they tend to be narrow and they tend to reward disproportionately those stocks that are at the top of the K shape. So I think we're cyclically, that K is somewhat, I don't know, closing or wherever the opposite of bifurcation is. I think we're kind of reconverging a bit.
Okay.
But I don't think it's I don't think the outperformance of large growth is going to be matched in the next couple of years by the outperformance of small value equally.
Mhm.
So I don't think it's a
Okay.
full rotation.
Yeah. Okay. But it sounds like, hey, if you've gotten used to these tasty gains in the stock market, um, you're probably more likely to get them by finding these pockets of the market that are going to be going through this healing process than just sort of riding the general market indices.
Yeah, absolutely. This is and I don't want to say it because everyone says it and it's so cliche, but this is an environment, of course, if this plays out, where being more active is, especially in today's benchmark, has a far better shot of beating it.
Okay. All right. Well, look, let's see where to take it from here. So, we well, I guess, why don't we look at housing and maybe use it as an analogy for some of these other parts. So the housing market has largely kind of been frozen, right? Um,
Yeah.
and I imagine part of the healing you're talking about is just, hey, transactions are going to start picking up here, right? That more and more people are going to be able to transact that either can't right now, um, either because mortgages are unaffordable, or I've got a house I want to sell it, but uh, at the new mortgage rate I'd have to take out, it just does, the math just doesn't math for me. Obviously, lower rates are going to start helping with that problem, right? Is this just a story of rates, or I think I heard you say that it wouldn't surprise you if actually prices came down in the housing market. And I guess this is sort of what I want to put my finger on, the heart of what I put my finger on, which is healing may mean lower prices, right? Like,
Yeah, absolutely. Absolutely.
like
At the
in
end
the
of the
housing market
day,
is a great example. When so much of it is unaffordable to so many people, that's
yeah.
not a healthy market, right?
Well, I guess, what do you like? What do we want? Do we want high prices and low activity, or do we want high activity with somewhat lower prices? I would take the latter when I'm thinking about the breadth of the economy.
Yeah.
And, I think we got to be careful about, everyone's got '07 in their minds, and, that is not the backdrop we have. And I know you speak with a lot of people who know a lot more detailed data in the weeds about housing, and yeah, I agree. The housing backdrop is in bad shape. Some areas are in very bad shape. Some areas are still, Northeast. There's no inventory still, so prices are still very high. We have an affordability problem. Well, how do you get affordability to improve? You need lower rates and or lower prices. Wages. If wages are the solution to affordability, we're going to be waiting a very long time. And I don't think we're going to get back to whatever normal affordability levels are. We had this affordability pop or unaffordability pop because of an event that took place with COVID, which both led to extremely low mortgage rates and a increased value of a house.
Right.
We still have people.
Sorry to interject, but I'll just say it was preceded too by an era of ZIRP, which had already pre-inflated housing prices artificially.
Um, yeah, I guess, yeah, I have to look at some of my affordability. I mean, it did, but I mean, what we saw in 21 to or 2020 through 2023, or,
Unprecedented. I
it
agree.
was just,
Yeah.
yeah. I mean,
Yeah.
even though we had 15 years almost of zero rate, sorry, not 15 years, 8 years of zero rates.
Yeah. I was just saying that happened on top of we could have had a inflated housing price discussion pre-COVID, and COVID just,
Yeah.
hyper
Yeah.
distorted it.
And
Yeah.
and that was because obviously it wasn't just a demand story. It quickly became a supply story,
Right. Yeah.
and both.
Yeah. Okay, so again, that's just a nuance I want to make sure that people are taking away from here. When you say, "Hey, it's going to be a healthier environment," that doesn't necessarily mean you think higher prices go hand in hand in that, and it's going to be different across the landscape here. Let me go back to the stock markets for a moment. So, you think that we may see some pretty good returns in some of these pockets of the market that are broadening out and healing, as you said earlier. I think you said, hey, we could definitely still see big tech do fine. But let me ask you this, Michael. So we don't know. So this is a big caveat here. But right now, there's a lot of concern of the level of valuation. You talked about the multiple expansion, but the level of
Yeah.
valuation in these AI hyperscalers, right? And we're seeing things like the round tripping of capital, right? That's beginning to happen with NVIDIA and some of its key customers. That, not saying it is, but it smells like some of the funky, suspicious vendor financing that we saw during the dot-com era. Um, there also is just talk of like, wow, the profits in the AI space, they may turn out to be a lot less than what the market's currently assuming here. Again, we don't know what's going to happen here, but let's just say for a
Mhm.
moment, um, there is an AI market valuation bubble. If the market changes sentiment on that, um, how does that change your outlook here?
Well, that would, given the concentration of that space, would likely have a equal negative effect to the extent of that change in view. When the DeepSeek news came out earlier this year, man, that feels like already like 5 years ago at this point.
It does, doesn't it? Yeah.
um, yeah, that was obviously a concern. Um, yeah, I mean that would change things. I mean, by definition, it would change things. So yeah, that is a risk. I certainly don't say that I am an AI expert, or I think you should speak to those folks that focus in on that sector specifically. I think a lot of strategists talk about it, but it's kind of more superficial.
Hmm.
Um, I think there's two risks. There's, of course, a macro component risk, which, when you look at the tech bubble in 99, 2000, you had, I would say, far more bubblicious than things are today, at least from a valuation perspective. And at the same time, we had a massive sharp tightening cycle into 99, or starting in the middle of 99, into an economy that actually was already just beginning to slow. So you had 20-year high prices in oil, and the Fed raised rates aggressively, and that really started to hit parts of the economy and took out a lot of the excess froth and speculation in the stock market. And excess froth and speculation was the predominant driver of that tech bubble. This is different. And I don't think I'm saying this time is different, because there's only, we're talking comparing to 2000 and 99. The fundamentals of this story are very different. I would agree we are in an earnings bubble, and, similar to how Bear Stearns and Lehman Brothers were in earnings bubble in 2004, 2005, 2006, though few people would say they were expensive, but that was because they had such good earnings that were not sustainable. So if the earnings view and the margins and the AI story really radically change, yes, the story's over and the story changes. From those folks that I listen to, who I think, know a lot more about it than me, and from the data I see, I don't think we have a macro risk that is going to just disrupt that like we had in 99. I mean, again, that was the beginning of a Fed tightening cycle. So right now, I don't see the Fed tightening anytime soon. I don't see a risk that oil is going to spike, or rates are going to spike, or unemployment's going to spike to cause that on its own. So then it goes back to really the story of the specific sector and the fundamentals of these companies, and are they going to radically change? And as of right now, I don't see that causing any kind of collapse and big downturn. But yeah, again, obviously there's risk in these assets. They're highly everyone owns some of it, and the question, the party ends when the catalyst that created the party ends. And in this case, it's not. I wouldn't agree that it's as much valuation as it is the actual fundamentals that are being generated. And at some point, yeah, that'll peak and roll over and slow down. And how quickly it slows and how much fluff was in those estimates will determine how much downside there is for those stocks.
Okay. I agree that I don't think that there's sort of like a credit risk that was the sort of thing that set off, the great financial crisis, right? But I just wonder, given how widely owned these stocks are, I mean, when they make up a huge chunk of the market indices, market value themselves, but they're also just owned in like almost every ETF that's out there.
Well, well, what I was talking about before, I mean, tech has, if we look back 10 years, tech is the only sector that's outperformed the S&P from point to point over 10 years. That is not common, perhaps even unprecedented. And let me see if I can show you some charts. Here's a chart of that.
Yeah, I mean, look at that. That's
so
yeah.
Yeah, and look at the S&P. That's the second line. So that's FANG plus 29. When the Fed cut in 2019 and long duration tech growth stocks started really doing well, and then COVID came along, which was also heavy tech, and then AI came along. Tech is the only sector that over 100 years has essentially remained in an uptrend. And I can show you that chart too. This is tech and comm services, because problem today is that sector definitions are not actually really correct, and they're kind of they're a little bit faulted. So this is tech and comm services, and yeah, it's at a 100-year high right now. And so you could see that chart and be like, oh, that's really scary. The difference, though, is this chart here on the left. Let me see if I can zoom in a little bit. Nope. Let's see. Oh, I zoomed out. Oh man, I got to do this. I'm sure there's a keystroke to this, but I don't know it. So
No worries.
so this is to me a really eye-opening difference. And again, just because it's different doesn't mean it's not risky, and this may not end well, or may end well. But this is different, and I think again, but that means it may end differently. So what this chart's showing here is the dark blue line is the weight of the least profitable stocks in the market. I actually have this data going back 100 years. It's from French and Fama. You could pull it up on their website. It's free. So
Okay.
if we took
So
the,
it's not junk debt. This is quote junk equity, right?
well, yeah, if we consider companies that don't make money junk, and
Yeah.
we're using it loosely here, so nobody get offended. But profitless companies, let's say the bottom 10%. So I would guess that the vast majority of them, most of the time, are not making money. So I'm showing that next to the weight of the tech sector back to 90, in this case, 95. So you can see some pretty distinct differences between the late 90s and today. So everyone's looking at the tech weight and saying, oh my God, look, tech weight is now, and I think we're actually now above those 2000 levels, or pretty
Hmm.
close, just above it, just looking at tech, not including comm services. And that really scary. And look at what happened last time we were there. But that dark blue line is a really important line, because that is not what has driven the tech sector, and just shows you how much more froth was in the market back in that period compared to today. And froth being lack of fundamentals.
Got it. Meaning the reckless willingness to speculate on junky companies that didn't have great prospects.
Yeah, well, think about the duration of these companies. Everyone back then, you could argue, well, looking at the chart, you could say, well, they were betting on, there was more of a bet implied in those prices, whereas today it's more of a reflection of realized activity and fundamentals.
Yeah.
And
Yeah.
so that is a fact. What that means, of course, it's just that is different. So we have to think about it differently, and we just got to be careful with comping a sample of one with 2000. But again, I would say there was far more froth in the market, in the equity market, and not to say there's not a lot of froth today between different asset classes and within the equity market, but I think there's less systemic risk compared to the late 90s, 2000s, early 2000s, as of today compared to then.
Got it. Okay. And I mean, I totally understand how this chart, makes that argument. We don't need to spend too much more time on this, but I guess just my
Yep.
question was, given how much market cap they make up, given what a percentage of holdings out there they make up,
Yep.
the big tech stocks, given how they are kind of in almost everything. I mean, you're hard pressed to find an ETF that doesn't have a healthy amount of the Mag 7 in it.
Yep.
Is there sort of a special impact that it has on the wealth effect, positive or negative, such that if there was a material repricing of AI stocks, and I'm not saying this is going to happen, I'm just saying it's a possibility, where all of a sudden that sector goes through a pretty dramatic repricing because folks just say, oops, there's not as much, the pot of gold at the end of this isn't as big as we thought.
Yeah.
Could it pull enough of the economy,
Yeah.
yeah, enough of the economy down with it, I
It,
guess, given the negative wealth impact?
absolutely. The wealth effect cuts both ways, and it's been a really good thing. And if you think about 2022, we can kind of use this as a little bit of a roadmap. 2022, we obviously had a big negative wealth shock from equities. However, at the time, there was a ton of income supporting the
Yep.
U.S. economy from all the stimulus. Like we were at max stimulus basically at that point. So in hindsight, we all know this now, that dramatic drop in financial assets, everything from crypto to equities and bonds. I mean, it was probably one of the worst portfolio. I don't know. There was not many places to hide.
There weren't many places to hide. Gold hung in there, but
Yep.
very few others did.
Yeah. And maybe some utility stocks.
Yeah. And T-bills, of
So,
course.
and yeah. Well, yeah.
That's when T-bill and chill really took off. Yeah.
T-bill and chill. Yeah. I forgot about that. So yeah, I think there's a very big risk. The bigger the market has become, the bigger the contribution of the wealth effect has become. And we typically think of the wealth effect as, well, the market going up, the market going down. But I think we have to think about the contribution of the wealth effect, which is
Mhm.
how big is the market as a share of income or as the share of the economy. And if you plotted those charts, it would kind of look similar to these. The stock market's about two times the size of the economy today.
So
So
the tail
it's
really has become the dog here.
absolutely. And I think if we look at all the policy of the last couple of years, and something we've written about going back to 2019, so this is before COVID, this idea that, because the numbers back then were also quite high, that the market has become too big to fail. And perhaps that's why policymakers, whether it's Fed policymakers, quickly and very kind of a rifle shot acutely making sure that the regional bank crisis in 23 didn't spill over, or the fact that we have kind of sustainably high deficits today. It's the policymakers are continue to pull out every tool they have, and they're very creative about it. And I think they will continue to do what they can to avoid a sustained downturn in the market, because it's become a bigger risk factor. And I think, the wealth effect is essentially, it's always been targeted essentially by the Fed indirectly. And it's a double-edged sword. So in 22, we had all that stimulus that offset that. And we had a repricing and everything. Tech stocks got really, we had kind of the post-COVID bubble plus inflation shock. So we had stuff, like large cap tech down, the NASDAQ down, I think as much as 33% or so. And then you had other well-known investors that were owning more long duration speculative tech names that, were clearly in a bubble and just got really decimated, down 60, 70%. So, and the difference there was the fundamentals were what held up better had better fundamentals. And what got destroyed is, where there was much more speculation and longer duration tech and growth and innovation stocks. So as we look ahead to now, there's arguably more risk if the market would decline so sustainably, because there's the labor market's softer, there's less stimulus to the consumer. Again, everything compared to 2022 is there's less stimulus.
Okay, so that's a big comment you just made, that the market has become potentially too big to fail here. And I guess I want to ask you, like, how, how does that make you feel being at that conclusion? Is it like hey, that's just how things have gotten to, or do you have concern over the fact that this is a dangerous place to be? The analogy that kind of comes into my mind is the old Peter Pan, Tinkerbell, like, you have to believe, if you don't believe in fairies, they die. So let's all believe that, let's all believe in this market. Let's all keep, making sure that we all think that prices are going to keep going up, so that prices do indeed coming up, because if they don't, then potentially this whole house of cards unravels. Or
Yeah.
similarly, and I'll let you speak, um, in the service of trying to keep everything going up, there's no free lunch. What pays the price? Well, what seems to have paid the price a lot in the form of the stimulus that we put out there during COVID, but pre-COVID and the stimulus we're doing now, running these massive deficits, is the purchasing power of our currency, goes down as a result of trying to keep this whole thing going. So how, to your point of sort of healthiness, how healthy is this situation?
Hmm. It's hard. I like to think in numbers, and it's hard to answer that quantitatively. But I think we've gotten to this point because of all the various fiscal measures and monetary measures that have taken place. And again, this is not just in the last 10 years. This has been going on for a long time.
Yeah.
And, quantitative easing, President Kennedy did it back in the early 60s, Operation Twist. So this is not necessarily new. It's just pronounced because our economy has become so financialized, and the barriers to entry to become an investor have dropped to zero. So more financialized economy means, I guess, we got more financial risk, and to mitigate that risk, we get these policymakers doing things that try to plug up problems from getting worse. I don't think we'll ever see, well, I don't want to say ever, but maybe hopefully not in my lifetime, we'll ever see a policymaker let a bank go again, like Lehman Brothers. I don't see that, that being allowed to happen again. And we could say, well, it's unfair, or it's not, a moral hazard. Okay, but I think having that view or disagreeing with it really sets the tone of how you think about the health of financial markets. So it is what it is, Adam, I guess. And instead of debating what's right or wrong, I just think we have to, as investors, and understand kind of what the rules of the game are and where the risks potentially could be. And I don't think that's largely changed over time for markets, regardless of how much it's up or how big it's become. But it's obviously become a big part, bigger part. But again, as long as the economy is doing okay, as long as we have good policy that allows for innovation and risk taking of businesses and capitalism, et cetera, and it's still, kind of the old, what is it, the Paul McCulley, the cleanest shirt in the laundry.
In the laundry. Okay, yeah, I got so many threads on this I'd like to pull, but I don't want to derail things too much. So let me build off your last point there. So I'd be curious to hear in general what scorecard you give the new administration, because its economic policies are quite different from previous administrations. And secondly, the intent of the new administration's policies, at least as I read them, is to really stimulate the economy. Um, Tax relief, deregulation, bringing a lot of foreign capital into the country. Uh, do you expect that they will bear fruit? And if so, the question becomes, okay, when? When do we think we'll start seeing some real measurable impact on the economy from these policies?
Well, I think the tax bill had some pro-cyclical policies in it, in the form of the expensing and freeing up, I guess, incentivizing companies that were either planning on doing it or on the edge of doing CapEx to do so, to free up some cash flow. So we're already hearing from companies on, how many dollars of free cash flow that's opening up. So I think we're already starting to see that, but that should have a long, I think, positive tail to it. It's essentially a tax cut without, as blanket of a tax cut as we saw in the first Trump administration. I think it's too early to judge the administration on how their policies are ultimately going to play out, because obviously things happen with a lag, and there's often unintended consequences or unintended positive surprises. I think having oil prices remain very low has been a super big positive in this backdrop. If you look at real oil prices, we're at a 25-year low, and that's part of this Goldilocks story. There's been a lot of concern from tariffs with respect to inflation, and we undoubtedly have a narrow inflation pickup from the tariff pass through. If oil was higher today, we'd have a bigger inflation problem. I know that sounds kind of obvious, but the fact that it's not kind of gives more room for that tariff pass through to not become a broader issue. So I think that's worked out for the economy thus far. But we'll see. We'll see how things play out. And I know the administration is trying to figure out a way to help the housing sector. In some ways, there's not much they can do, besides trying to get rates down and inflation down, which probably the healthiest way to help the housing sector. So we'll see. But I would say the economy has momentum now because of many of the administration's policies. There's been some things that, again, whether I disagree or not, it's not the point. The point is whether I think it's going to be a positive or negative for the economy, the market, and for many versus, few. And so I'd say I think the future right now looks brighter given those current, given my recent comments so far.
Okay. All right. So we're kind of getting the last 10 minutes or so, Michael, getting kind of the so what. And obviously, if there's anything key that's on your radar we haven't talked about yet, please introduce it. But like,
Well,
okay, I'm a regular person watching this video.
yeah.
Michael has just told me, hey, things actually might actually start kind of getting better on net in the future with the nuances that you've described for us. Um, how does that translate into an investing thesis from here?
Yeah, so I'll keep since I think I'll keep it broad because I think that's where I think things are moving. But I'll keep it to the indices. But maybe I'll talk through it and talk about two different things at once because I think there's a misconception around the stock market and rising unemployment. And if you see this chart right here that I'm showing,
I do. Yep.
so that is the S&P 500 and the unemployment rate, which have been moving together. And again, I, most people, I actually just did this morning. I put a survey out on Twitter and said, how many, of the last 10 recessions, how many times did the stock market go up while the unemployment rate was rising? And I think everyone pretty much got it wrong, or probably asked ChatGPT. I bet very few actually looked before they answered. So the answer is actually quite often. Look at these four charts. Make this a little bigger. So there's your 1990 recession, 1980, 1960, and 1953. Does that surprise you, Adam?
It does surprise me. Now, I will say it looks like most of these started with a pretty big correction in the stock market,
They did.
after which stocks rose with the rising unemployment rate.
They
So
did.
it's not that investors got off without taking any licks.
Perhaps, but I think, and this is where I think, people actually doing some work and understanding what was going on here, it can be really helpful because I think the general conventional wisdom is that, well, the unemployment rate's rising, so I should get more bearish. And, that was right. And here's '07 and 2000. Absolutely. As soon as the unemployment rate started going up in those two periods, the market went down essentially until the economy broadly bottomed,
Mhm.
2 years later in both cases. So that's not what happened here. So I think the message I'll convey is I think equities. I think yes, they're expensive, but I think they're going to remain expensive. I think they will continue to rise. I think they will continue to broaden. I think bond yields will continue to slowly come down. And perhaps, if you look at the 10-year, we've kind of been in the sideways range for 2.5 years. I think we kind of settle out at a lower range. I don't see it going down to 3% on the 10-year, like 3.00. I don't see the Fed aggressively cutting. I think we're in this Goldilocks backdrop where, yes, the employment backdrop is soft, but that opens the door to rates to come down, which makes the housing backdrop better and the manufacturing backdrop better, which makes earnings backdrop better. All of what I just said, I think, is actually a pretty decent backdrop for equities. So I guess my message would be to stay long and look for opportunities of stocks that are cheap, undervalued, underloved, undercrowded, that have really lagged for the last couple of years and potentially could see some upside under that scenario. So if you look at these four examples, yes, you did see the market, in 1990 right here, right? That big draw.
Yeah.
I can tell you for a fact that had nothing to do with rising unemployment. One, because at the time it happened, unemployment was down here. And I don't know, I don't really know any time the markets actually went down before unemployment went up. Side issue. This right here was the spike in oil prices during the Persian Gulf invasion.
Mm.
And this day right here, which was the day the market bottomed, was the peak in oil when Bush Sr. said, we're going to get involved, the US, and That was the end of that. That was the end of that bear market. And so even if you don't want to buy that, but I advise anyone to go look at that chart. It was actually something I guarantee in one of our last few interviews, if we were talking early this year during the tariff thing, I was showing all these charts of every time the market goes down, it's what caused it to go down. When that sees relief, it goes back up. And we were
Yep.
talking about trade uncertainty. And I
Hmm.
guarantee I showed you this chart, not with the unemployment rate, but with oil. But look, it then when oil bottomed, the market oil peaked, the market went up for the next 2 years. And
Yep.
unemployment during that time went from 5.5 to 7.75. In this period, I mean, I don't, the market really didn't go. I guess you had this down move right here. That's 1980. That's when Volcker raised rates to 20% right there. And then look what happened. Unemployment went up. And what did he do? He cut them to 14, cut them down pretty sharply. Market
Yeah.
rallies with higher unemployment. Why did he cut rates? Why did the market go up? Because rates came down. It's the same thing happened here in 90. And then 1960, again, unemployment and the stock market were moving together. And I mean, I don't really see unemployment having any effect. Again, I don't buy this idea that the market's like so forward looking of unemployment. Like that wasn't the case in '07. That wasn't the case in '01. The S&P was at back to all-time highs in August
Hmm.
of 2000 before, and then as unemployment went up, it went down. So right here, again, it was interest rates, which were probably rising. And then boom, the Fed cut why? Because unemployment went up and the market followed suit. Same thing
Yeah.
happened here. The market was going down because rates were going up. The Fed was tightening in 1953. Then they stopped tightening and cut. Market bottomed. Why? Because unemployment rate went up. What's happening today? Same idea. We had this inflation problem. And then in 2024, we had from April through right here through here 4 months of rising stock prices because we had unemployment going up, and then we had a bit of a too cool unemployment number in the August or July report, which was early August, and the market kind of freaked out for about a week, and then all the employment data got better, and oof, we breathed a sigh of relief, and the market kept going up. So I think this can actually persist for as long as the unemployment rate doesn't go like that, like really sharply vertical. Because again, we're in a backdrop where everyone is so fearful, overanalyzing high rates, high inflation, and there's nothing more bullish for bond yields than soft employment to a point that's good for equities. And the commonality in all four of those examples, and by the way, I talked about this in my podcast last week. The title was the enemy of my enemy is my friend. And the point is that our enemy is inflation. The enemy of inflation is higher unemployment. It really is very deflationary. So therefore, higher unemployment is my friend. In these four examples, 1953, 60, 79, 90, housing was improving in all of them.
Okay.
Not necessarily
I'm sorry to interrupt, but
perfectly.
this is where I was going to go, which I wasn't actually that shocked as you started explaining this,
Yep.
because in your framework, E in the Hope framework is the laggiest last domino, right? When
Yep.
the economy is slowing down, and it's the last domino to recover when things start picking up. So I was going to ask you, so presumably when you hit the bottom in the stock market, housing, orders, profits were starting to improve, even though employment hadn't gotten the memo yet. Sounds like that's exactly the case.
Well, and it was higher unemployment that allowed that to happen. That's the point. It's a circular loop. That's right. I mean, look, this is why the Fed cuts. See those green dots?
Hmm.
Notice they're all at periods with the gray lines going up. So
Yep.
in some ways, you need higher unemployment when you're in a bifurcated state because of high prices and high interest rates to produce the lower interest rate healing that is necessary to lead things to broaden out. And that is why I call today's backdrop Goldilocks, because we need higher unemployment. Why did the Fed cut last year? Why is the Fed cutting? Why did they cut last September or both Septembers? Unemployment, not about inflation. So again, there's obviously a limit to this. If in 6 months from now unemployment's at 6%, I would say that was probably too cold. But I don't see that. I think we've gotten past the risk of, or the past the window of the highest risk for the economy to see a downturn. And whether it was fiscal stimulus that kind of carried through, or the combination of oil going down when the Fed was raising in 23 and 24, helping to offset some of that, or the stock market creating such a massive wealth effect, and the housing market, for whatever reason, and anything else, we've, I think, gotten past the window of biggest risk. Now, I do think the employment data is going to remain soft, but I actually see that, if let's try to be forward looking, as a positive. And I think today's a
Yeah.
good example. We got bad ADP in the market. It's not tanking because rates are down, and everyone, the conversation next week is going to be, oh, maybe the Fed will cut 3 times.
Yeah. So, Michael, is this analogy accurate where to have the recovery eventually, you need the fire of higher unemployment? Because what that does is it makes the central planners come out with their fire hose to put out that fire, and that water germinates the seeds of the recovery.
Yeah, in some sense, and also the amount of, if you look at this chart, and I like to look at a lot of single variable, or two lines on a chart. I don't like using regressions, and I rely on kind of common sense stuff. So we can have a business cycle or an acceleration or deceleration without a recession. It's just they won't be as booming. They won't be as dramatically strong. Like I can't use 2019 because we had COVID right out of there. But and even in, that's what soft landings are. They tend, they're soft landings, but soft landings usually don't initially kind of come out of the gate booming. Recoveries out of a recession do, because there's a lot more stimulus behind it. So if you think about kind of Sir Isaac Newton's action reaction framework, this is that with a lag. And so the action, i.e. the stimulus, due to the higher unemployment rate and lower inflation, the Fed cutting, to the extent they do that, that creates an understanding of how strong things could become thereafter. And so I think it's going to be slow and steady stimulus, because I don't think the unemployment rate is going to be skyrocketing, spiking aggressively higher. And I think that's a good thing. We don't want these boom bust, we don't want the Fed to be aggressively reactive. We want them to be steadily proactive.
Okay, that makes a lot of sense to me. Obviously, it sounds like you'll change your tune if unemployment rises a lot more aggressively than you think it currently will here.
Yeah, and I could show you a chart real quick on that. Just
Okay. But it sounds like your advice to
yeah.
investors right now would be, hey, don't get shaken out of the market. There's a lot of reasons to still want to be long here, though you might want to be more active in your approach. Just take care not to lose your job.
Yeah, and the unfortunate thing is that, so for the market, and I would argue for the broader economy in this backdrop, where again, high rates, high prices has been a big problem. Unfortunately, I said earlier, no pain, no gain, but unfortunately, some are going to have to see their job go away. The the aggregate will benefit from that. I don't know how to say that. I mean, it's a shitty thing if for lose your job for any reason, but that's always been the case, across history. When there's easing, right? How many times would the Fed have cut rates if we never saw unemployment go up? Very rarely. So my point is that as long as it's slow and steady, and the unemployment rate is creeping higher, not shooting higher, for housing, think about this, you get a little bit of an uptick in the unemployment rate, which is what we've had in the last few months. And you get mortgage rates now at, they're at multi-quarter lows, and you got refi activity improving. You've got mortgage purchase apps grinding higher. Again, nothing booming. And you've got data sets that suggest that in the next 2 to 3 months, we should see, some follow through from that in the housing data. Now, if we don't see that, that's what will get me to kind of question, because that's why I have the H.O.P.E framework. So for this whole story to play out, we need to see housing data grinding higher. Yeah, it doesn't need to boom. I don't need the NHB at 80. I just, it's at 40 now or something. If it goes to 45 to 50 to 60, that's phenomenal. So don't underestimate, how little it would take from a area that everyone's very bearish on to really quickly change the narrative and start extrapolating something positive. So I think it's a very unique backdrop, but I think, similar to those other four episodes, we're in a dynamic where we could have this Goldilocks backdrop. And unfortunately, you need higher unemployment for that. Here's something completely, counterintuitive. Russell 2000 stocks are up because unemployment's up. It goes along with the counterintuitiveness of home prices were up in 22 and 23 and 24 because the Fed raised rates. But that's the dynamic we're in. Why did everyone jump into small caps the last 3 months? Because the Fed's going to cut. Why is the Fed cutting? Because unemployment's up. So again, you got to watch this for the pace. And this is the chart I wanted to show you. The pace of rising unemployment has gone from a 15% rise a year ago, where it was, going from really low levels at 3.5 all the way up to 4.3 in 2024. And it's at the same level that it was as it was last year, which means it's at the same level as it was last year. So yes, we're seeing lower, weaker numbers in some of the NFP data and ADP, and I think there's a lot of reasons for that. But again, I think it's going to remain soft, but not systemically problematic.
Okay. All right. Well, look, that's people keep asking me, hey, where are the optimists? I would put you in the guardedly optimistic camp right now, Michael. So, thank you so much for coming on and being so transparent with all your data here. It's so fascinating, but just so helpful. Would love to have you come back on in a couple months, Michael, just to give us an update. Everything's playing out the way that you thought, or has there been any curveballs along the way? Most important question for you. Where should folks go who would like to follow you and your work between now and the next time you come on?
Sure. I'm on X at Michael Kantrow. I'm on LinkedIn, but I post there sometimes. Of course, if you're an institutional investor, an RIA, you can reach out to Piper Sandler or reach out to me at Piper Sandler. We also earlier this year launched an ETF that is an actively managed small cap ETF, partnering with a firm called Simplify Asset Management. The ticker of
Mike
that is,
Green's
yeah, absolutely, Mike Green's firm. So the ticker of that is Little, LITL. We launched that in April, late April, I think, or late April. And so that's a way, that's one of the ways we try to take all of what I'm talking about, what we end up doing with all this for institutional clients, putting together baskets of portfolios. And they're baskets that are a function of what type of flavor of equities the market's going to gravitate towards, large cap growth, small cap value, that's a super high level way to think about it. But so we do boil this down to actual stock recommendations for institutional clients, and the little ETF is our long model within the Russell 2000 small cap space.
Yeah, and that's available to anybody. So anybody watching this video who wants to get some exposure to you and an actionable part of what you just mentioned for us can go look at Little.
Yeah, and within the context of today's discussion and the market and valuations, et cetera, and risks or little risk being priced in, our current recipe is heavily earnings focused. And again, that's how I think the types of names you want to own going forward. Don't just own a name because you think the Fed's going to cut, and if that works, then the stock will go up a lot. Don't just own something that needs a macro catalyst. Own something that has a fundamental catalyst, in a macro backdrop that's not, dramatically changing, certainly for the worse. And I think that's going to be the big difference from where we've been the last 3 years, where PEs and valuations have all extremely moved higher, and where we're going forward. Credit spreads at all-time lows. This is about setting us up for a very idiosyncratic backdrop.
Okay, Michael, I'm shocked that you mentioned the F word on this public program. Fundamentals. They haven't mattered for such a long time. Yeah, and you're
the
saying
F-bomb.
yeah, the F-bombs.
Well, see,
But
I
what I hear you saying,
disagree with that.
in this
I
new world
disagree
that,
they haven't mattered.
yeah.
I so strongly disagree that fundamentals haven't mattered. The best performing stocks have had the strongest fundamentals. And when we look at valuations, well, fundamentals are macro. Look at these four charts. Look at the profit margins of the S&P in the top left. Look at inflation inverted with the S&P in the top right. Look at oil in the bottom left. Look at credit spreads. There's reasons valuations are high. These are macro fundamentals tied with micro fundamentals. We should have really high PEs today. The risk is not that they're high, it's that we get a problem that these charts, the lines go down because oil spikes, inflation spikes, rate spikes, or as you mentioned earlier, the AI margin story collapses. The market never has gone down just because it's expensive. Something in the narrative changes, and understanding what the narrative is, of course, the first step to understanding what could change.
Right. And as Lance Roberts reminds us every week on this program, at the end of the day, what's going to matter is earnings and earnings expectations. And so it doesn't matter what the narrative is, doesn't matter what happens until and unless it impacts expected earnings. Yeah.
Yeah. But I'd say going forward, the risk to markets since 2022 is going to continue to be in periods where fears of around inflation and rates going up flare up. And that can come from the economy really being strong, or that and a combination of inflation, and commodity prices moving higher. And I think we'll see some periods of that next year in 2026.
All right. Well, when we do, I'd love to have you back on this program to discuss them. Michael, I really can't thank you enough. So, oh, and by the way, when I
Always a
edit
pleasure.
this, I will put up the links on the screen to your X handle,
Okay.
pipersandler.com, the little ETF and all that. And folks, the links will be in the description below this video as well. But again, Michael, can't thank you enough. It's always such a pleasure.
All right. Always same here, Adam.
2, 1. All right. Well, now's the time on the program we bring in the lead partners from New Harbor Financial. I'm joined as usual by John Lodra and Mike Preston. We'll hear their reaction to the interview we just did there with Mr. Kantrowitz, and then we'll talk about what's been going on in the market over the past week because a number of things have happened. Gentlemen, thanks so much for joining me. Mike, why don't we start with you? I know there's a lot there in that discussion with Michael Kantrowitz, but what were some of the key things that you most reacted to?
Thanks, Adam. I'd like to just respond to the highlights, I think, that Michael talked about there, and one or two points that I think we've got some disagreement on. But respectfully, I think it was an excellent talk, and he's talked about some of the themes that we've been noticing internally as well. Number one big theme I think he talked about is the fact that the Fed has seen and the economy has seen softer unemployment data, or softer employment data, I should say, has led the Fed to start cutting rates. That has been positive for equities, particularly small and mid-cap companies. Our systems are showing us that the market is broadening out too. Now, we don't know if this is going to continue, and we haven't seen enough broadening to really trigger our own measures of relative strength of, for instance, mid-caps versus S&P, because our systems have a relatively high bar. Just as an aside, we're happy to jump in at higher levels once our indicators tell us to, but there are early indications that mid caps and small caps are starting to broad out. Michael talks about that, the paradox that employment numbers are going to have to get worse for there to be further fuel, particularly in mid caps. Well, we'll see. We'll see. He does touch on some things that we're really concerned about, though, and he seems to be less concerned about them than we are. For instance, he says that we've had this market that's been overvalued for a long time. In fact, he talked about stock market capitalization divided by GDP, which, by the way, is up around 220%. These are nosebleed levels. He doesn't seem to think that's a big concern, though, because he talks about a number of different things. He talks about um, the central bank, the Federal Reserve, that's been very involved, and said one thing that I'm a little bit concerned about. He said, I don't see a policymaker letting a bank fail again like they did during the great financial crisis, Lehman Brothers. Maybe he's right, but yeah, I think I take the other side of that. I think that perhaps the policymakers don't want to let a bank fail, and maybe they'll be successful. But I personally think the market is likely to have a date with destiny. And finally, data is going to matter, and central banks will likely not be able to bail out the market this time. So we'll see. There's been two big bubbles in the last, 30 years of my career. There's been the great tech bubble, then the housing bubble, and now we're in the everything bubble. And I think that Michael's a little bit too optimistic in the fact that he thinks that this bubble can be kept from bursting, and that even if it does burst, that central bankers can bail it out. So um, the way that we approach all of this is we acknowledge that there's additional risk in the market because of insanely high valuations that history tells us always has some kind of correction or equilibrium. I don't really think this time is different. And the way that we handle it is we've got a relatively lower equity allocation, 45%. And we have stops in place, at least mental stops in place, and we have options that we can use to hedge. And these things helped us, for instance, during the April timeframe when we saw a 20+% drop in the market. We were only down low to mid single digits at worst for most accounts. And so, he acknowledged that a more financialized economy equals more financial risk. Absolutely agree. I think that we just think that that financial risk is going to be realized through some financial pain. So, whereas Michael's very optimistic, I would say that we're slightly bearish slash pessimistic. I don't want to say we're pessimistic. We just look at the reality of what we think is coming. And we view our date with destiny as being real because of where we are in this cycle, this fourth turning cycle. We think we're in likely the last 3 to 5 years of a fourth turning climax. We can see central bankers throwing every single thing at this problem to make sure that it doesn't come to roost. We think they're going to fail. And so therefore, I just don't see a lot of optimism. It's not to say we're bearish, we're not short the market, we're long the market. Clients are enjoying good returns this year and last. We really view our job of bringing people through this and try not to get hurt on what's the turn in the market and what we see as the big drop ultimately. It's not an easy thing because we kind of have to play the game, but be very cognizant of the risks and be ready to batten down the hatches and put our hedges on if need be. So that's the way that we see it. Lastly, I guess I'd say with his final thesis, he basically said stay long and look for laggards in the market if it broadens out. Don't get shaken out. I'd say this, in this type of market, which has been straight up bull. In fact, we've got another new high here in the market as we speak today. Personally, I think you're better off staying with leaders than laggards. I don't think that value is the place to be right now unless we start to get those signals. Market leaders have been leaders and will probably continue to be leaders if this market stays strong. So we probably have a disagreement there. And he talks a bit about Goldilocks again. We just we think it's a very dangerous time, and we'll see who's right. So with that, I guess I'll take a pause.
All right, thanks, Mike. And again, I want to note that look, this is why we have markets, folks, is that people look at the same data differently and come to different interpretations. Mike, I think that Michael Kantrowitz, obviously I can't speak for him. I think he would say, hey, to a certain extent, Mike, I share some of the concerns that you have, but until they start really materializing in my dashboard, in this framework, I'm not going to worry too much about them because the framework is what he uses to look at kind of the market that we have today, not the markets that we wish we have. But again, I'm sure there are some additional points of difference. And again, that's why we have a market. Smart people can look at things differently. To that point, John, feel free to add anything on to what Mike said there, but let me just redefine what I wrote down when Michael Kantrowitz was talking about Goldilocks, because I get it, right? He says, look, economic growth is good. And on the day that we're talking, I checked earlier today, the Atlanta Fed GDP now estimates coming in, I think, at 3.9% so far for Q3. Now that'll bounce all around the place, but still, that's not bad. Low inflation, and while people might argue in the comments whether they think inflation is truly low or not, it's definitely a lot lower than it was 2 years ago, right? The rate of inflation annually. Lower rates. Lower rates are coming down in part because of weakening employment. But Michael did a really good job of kind of walking us through why that provides the fuel for economic growth going forward. And then, as Michael said too, we've got low oil prices, and there's no doubt that is not helping the economy and keeping inflation a lot tamer than it otherwise would be. So, if I didn't show you the valuation charts that Mike Preston here was just reacting to, and I just noted all those factors, I think you might say, yeah, those are pretty good conditions for stocks. So, how do you, again, react in any way you like, but I'd love to hear kind of your reaction to that Goldilocks scenario too.
Yeah, hello, Adam. Great to be with you. Yeah, so when we hear the word Goldilocks, I also think of another guest of yours who I think we can both call friends, Darius Dale.
Darius Dale, yeah.
In their framework, their grid framework, one of the four economic regimes is Goldilocks, and I'm certain that just because we follow some of their work, that they also conclude that we're in the Goldilocks framework. And I think both Darius and Michael, and I know we here at New Harbor, we don't, that word isn't meant to interpret that everything is great and everything is just with the world and just with markets. No, it actually, I think every one of us in our way would say it speaks to, a set of conditions that can further distort things. So if we're in a bubble, a Goldilocks market can just make that bubble last longer and go higher. That's really, I think, the takeaway. It doesn't mean that, we agree with the market backdrop and that it's immune from ultimately correcting. It just means that the conditions are permissive, at least for the time being, for things to be, held together with tape and duct tape and staples and whatever you want to imagine. And that's why even though Mike rightly points out we're about 45% in equities, we'd probably be much less in equities if it were just valuations alone. And I will point out that, yeah, we're only 45% in equities, but it doesn't mean we're not in anything else. In fact, probably the untraditional portfolio that we've had, and this isn't investment advice for anybody listening, we've had a much higher than traditional market weight in things like precious metals and commodities and non-dollar denominated assets. So, even though we're underweight equity, it doesn't mean there aren't areas that one can look to for uncorrelated performance, even in the face of a significant bubble. So that's the one thing I would just add to what Mike and you have already talked about there.
Okay. Well, look, so one of the things that Michael Kantrowitz talked about was this broadening out and look for sectors that have been unloved and that may start faring better.
Mhm.
And one sector that I've been looking at increasingly closely is the energy sector, but especially oil. It has, as the oil prices have come down, the price of oil seems to be relatively low. I want to say, I think somebody said well, anyways, price of oil low, price of the oil related stocks seem to be, we'll say not loved by the market right now. And it's an essential commodity for the world. Oil is probably one of the most cyclical commodities out there, right? It tends to be sort of a boom bust type of industry. And so obviously in the spirit of, hey, you want to buy low and sell high, I think there's a pretty decent argument that can be made that this may be a really good buy low moment in oil. I understand that you guys have made some recent changes to your portfolio there at New Harbor. I'd love to know what they are, but I believe energy, maybe even specifically oil, are part of those trades.
Yeah, we actually just yesterday, I don't know when this video will air, but just yesterday we did a lateral move within our portfolio. We had a slice of energy pipeline master limited partnerships in a vehicle that holds several of those. And we saw a distinctive improvement in kind of some of the traditional energy names. We actually added a slice of an ETF that holds a diversified basket, well, basket, not diversified, basket of companies within the oil and gas services. So these tend to be obviously you can invest in large oil companies, energy companies. That's one way to play it. The energy services tend to be a levered way, not debt levered, but a more operating leverage kind of way to play an improvement in the space. And I'll just show you a chart of what that looks like. I'm going to share our what we usually use as a charting tool, so-called point and figure charting. And this is an ETF that we added yesterday. And this is not investment advice, for folks that are watching at home. We do this for our clients, knowing their situation and how it fits into their overall portfolio. But you've seen here, this is going back, several, a few years. 24 starts here, 25 starts here. You can see all while the market has been powering higher, this sector had been struggling until just recently. We've seen some dramatic performance improvement on a technical basis, but also on a breakout. We've seen this, every time these column of X's signifies a rising price, and you see there's been several successive breakouts above prior resistance points. Just the setup has been such that it's very much come on our dashboard for a valid addition to the portfolio. It's up nicely in the couple days we've owned it, and that's not, a couple days does not make a trend, but we had enough improvement across our technical dashboard to, justify adding it to our portfolio. I would like to comment briefly on Michael's pointing out at the improvement in kind of small and mid caps. And let me just share a dashboard here that is another one of our tools. And it's kind of looking at what we call fund scores. And these are just the broad U.S. equity styles and capitalizations. And the fund score is it's a pulled together on a technical dashboard put together by Nasdaq Dorsey Wright. And it's a combination of trending and relative strength factors. About 1/3 of the weighting is trending, price trending. The other 2/3 is relative strength, both peer-to-peer relative strength, but also relative to markets. And you can see the direction here. This is the move, the relative move in scoring over the last 6 months. And you can see at the top of the heap, the biggest positive moves have been in kind of micro cap and small cap. Now that is, I think speaks to a lot of what Michael Kantrowitz was talking about. These things have rallied on the removal of some concerns. Lower interest rate expectations tend to have an outsized tailwind effect for this segment of the market, which tends to be highly levered, relatively speaking, and a lot of the debt is variable rate debt. Now it's time for this sector to kind of prove itself by improved earnings and improved, relative strength. It's still, the fund scores are definitely still lagging. For example, the S&P 500, which is nearly a 5 versus, and this gets really into the weeds of what we do here. But all to say is we have seen improvement there that has been early but promising. And that would speak to a broadening of the market that we would want to see that this market likely has further legs, even if some of the market generals and the Mag 7 and large tech stocks start to kind of stall out here.
Okay, and if you were to see that, which would be corroborative of Michael Kantrowitz's thesis, would that then lead you to increase your percent equity exposure in your portfolio?
It very well could, and it also might warrant a tactical shift, a rotational shift from some of the large caps into the,
Yep.
If you go back, for example, in the wake of the tech bubble busting, small caps outperformed tremendously, in the wake of that. So just because we may have a dramatic pullback in cap weighted stocks doesn't mean all segments of the market are beaten down equally. We can rotate, and generally speaking, unless we get a meaningful pullback in the market here or something dramatic on the fundamentals front, we're probably not likely to get more, significantly more invested in equities. What I would expect is more likely a shifting on, within the composition of our equity exposure.
Yeah. Okay, great. And for folks that, took note of me kind of prodding Michael Kantrowitz to talk about what would happen if there was a major correction in the AI stocks. Look, I have no idea what's going to happen with that, but I understand the growing concern out there, and I think amongst the material number of viewers of this channel as well. There's an increasing number of really big names, many of whom are involved in the AI industry, who are outright saying, "Hey, it looks like that industry is in a bubble right now." So just know I have been trying to land a guest who can talk really knowledgeably about that. For the many folks who are pinging me to get Fred Hickey on the channel, just know I've reached out to Fred a lot. He is unable to come on anytime soon. So I'm continuing to look for others. But just know that that is a topic that I am hoping to do a dedicated interview on at some point, relatively near future. Mike, coming back to you, other big news this week is as of midnight last night, the US government has just shut down. Um, so market doesn't seem to care at all about that so far. But what implications, if any, do you expect investing wise from this government shutdown?
Really nothing. Excuse me, really nothing, Adam. I don't think that there's anything to really be concerned about regarding the shutdown. There's data out there, and we looked at internally a chart this morning that showed stock market performance and gold market performance during all of the previous shutdowns, and it really hasn't mattered. And in fact, as we speak today, and John's sharing that chart right now, as we speak today, the S&P 500 is touching a new high. But this particular chart shows gold prices, and that's in the white charts in the center during the last three government shutdowns. And I think you can see that really it's nothing. It's a nothing burger by and large. And if you look at on the left side, the chart shows really, I don't see any statistical correlation here or any trends. Sometimes the market's down in the week after, sometimes it's up in the week after. So, and I think this is mathematical proof that it doesn't matter. And I could say right now that both gold and the stock market are at new highs right now. So, as far as the government shutdown goes, I wouldn't take your investing signals or cues from that. There's always a solution. Almost certainly there's going to be a solution here as well.
All right. And just to make sure it's crystal clear, doesn't sound like you guys are making any changes whatsoever to your portfolio allocations because of the government shutdown.
Not based on this, Adam. We always take our cues from technical signals. Not we're not making any changes based on the government shutdown. If the market does something different, if the market were to collapse or drop severely, we would certainly end up taking some stops. If the market goes up even more, which is kind of what we anticipate short term, we're not likely to make any major changes either, other than perhaps tighten hedges, tighten stops, maybe take some profits into that type of ramp. But we're not going to get a whole lot more aggressive if the market goes up from here. If it goes down from here, we're going to take appropriate defensive measures. But in the meantime, we're not really doing anything instantaneously based on the news of the government shutdown. We just would prefer to take a wait and see. And if I had to guess, it's probably going to be short term up versus down.
Okay. All right. Well, look, we only have a couple minutes left. Mike, I will come to you for this question, then John will come to you to wrap it up with any major trends you're seeing with the actual real live people that you're talking to in your day-to-day work. But before we do that, Mike, real quick, gold and silver, I think on the day we're talking, I've been recording for the past couple hours, but last time I checked, gold was, I think, back at an all-time high. Silver futures, at least, I think we're maybe back above 47 bucks an ounce. So silver getting close now to its all-time nominal high. Anything else to say about the incredible bull run that we've had in the metals over the past couple of months?
Yeah, I'd like to point out a few things on the chart, and we're going to use our charting package Think Pipes, in which it shows SLV easier than spot silver. So let me just point out a couple things here as this is coming up. So here is SLV at 43 right now. Hit another high today, 43.40. And as you said, spot is up around 47 or so, about $4 higher than this. This has been an incredible run. This is a daily chart. This light green line is the 21-day exponential moving average. Once we broke out of this area down here, and I'll go to the weekly chart in just a minute, it's been nothing but up. We broke out here from a triple top back in, I guess, June, and it's been really respecting this 50-day moving average, and more recently, as we've accelerated, it's respected this 21-day moving average. Having said that, we're getting really stretched. It's getting hot in here, as they say, and there's some contrarian signals. Some prospects and clients are talking a lot about gold and silver, asking about them, and even though we believe that they're going higher, we know anecdotally when people start to go all in or start to want to talk about that more than anything else, it's at least a short-term caution sign. Here's a weekly chart of SLV. We're on 9 weeks here now, straight up. Here's the triple top that I was talking about back on $35 spot silver. We were talking about this all during this time. We haven't gotten anywhere near the 21-week moving average. Now, I remember a few weeks ago you had Sven Henrik on, and he likes to use the 5-period exponential moving average. So let me change that. Here, I don't know if you can see it, but that light green line on the 5 exponential moving average,
Yep.
this market's been walking straight up there. But, we're starting to really put in some white space, or in this case, black space below there. All that is to say, we're getting really kind of hot, really, really kind of not necessarily overheated, but we're telling people all the time here, if they're feeling nervous, if they're overexposed, if they need money for other things in their life, they should start taking some profits into this ramp. And
Yep.
guaranteed, you're probably going to sell too soon. We don't think you should sell everything, but sell 10% here, another 10% if we go higher, another 10% if we go higher, that type of thing. Take a look
The
at.
other thing, let me just add on to that too, which is, hey, not only if you're feeling fearful, but if you're feeling greedy, right? If you're really being honest with yourself and saying, you're really just enjoying these daily huge moves up, and you're beginning to expect future ones just because that feels like, a natural force now. That oftentimes is the classic trap that you get in near the end of a bull run. And so, consider taking the advice that Mike just mentioned. And if you really don't want to sell any of your core underlying positions, that's fine. There are other ways to hedge. We've talked about them before on this channel, but obviously, if you want to talk in detail about the full range of options, talk to your financial advisor or give the guys here at New Harbor a call. But the point is there are lots of different ways to try to give yourself some downside protection if indeed we are, at an uncomfortable risk of a pullback happening at some point in time.
Yeah, absolutely. We'd be happy to speak to anybody that wants to talk and talk about how you can use things like options to create collars, both a ceiling and a floor on an asset, that type of thing. But the simplest thing to do, perhaps, is just to start selling a little bit. I'm going to continue focusing on silver because it's been, as we expected, it's been better than gold in terms of its percentage move up lately, although gold has done very, very well in its own right. But take a look at what happened back in 2010, 2011 when silver had its move last time. It had 3 big months straight up, pulled back to the 5-period exponential moving average, and then had a blow off. Here we have 1, 2, 3, 4, 5 straight up months, well off the 5-period moving average. And who knows, we might extend further, but we shouldn't be surprised, going back to the daily chart, if we start to get some sideways consolidation here. And so, who knows, maybe this is some kind of shooting star that's being put in today. I think some folks thought that was the case a couple days ago, but here we have yet another high. Just know yourself. The investors should know themselves. And if you're starting to feel greedy, like you said, if you're starting to expect every single day to be up, I know that I've looked at the market each day lately thinking, wow, it's up again. And some people out there are probably feeling that it's going to go up forever. It isn't. So just get to know yourself and, again, sell into this rally a little bit. Perhaps makes sense for you, for most people. Again, everyone's different. We're happy to speak with you about your personal situation, but ring the register a little bit and use that money elsewhere. It'll give you more mental flexibility later.
All right. Thanks, Mike. Okay, John, just in our last couple quick minutes here, anything that you are seeing or hearing from the general investing public in your discussions with the folks from the Thoughtful Money audience that reach out to you or your existing clients?
Nothing that we haven't already covered, Adam. There has been, and we always get this time of year, kind of a tick up on year-end tax planning, taking stock of where folks are on capital gains or losses, and being smart about that. We talked in our feature video with you last week, Adam, about year-end retirement saving tactics, funding IRAs, corporate retirement plans, Roth conversions, which can be a savvy way to try to smartly take elective distributions from IRAs, traditional IRAs, and convert them into Roths, pay the tax now, but for thereafter would be tax free. I do have to make a correction, and hopefully some of the viewers that saw our video last week, I misspoke, and I apologize for this. So the deadline for funding traditional or Roth IRAs is actually tax filing deadline, not plus extensions. So April 15th of next year to make a contribution for 2025. Now, SEP IRAs, for example, for retirement plan IRAs, it's deadline plus extension. So key distinction there that I misspoke about last week. The Roth conversions, I'll remind folks again, that's got to be done by calendar year end. You don't
End of the calendar year.
So just those are no-brainer things to be thinking about for folks that are as we approach year end here. And don't wait till last day of the year. It's always a crunch for the custodians and folks like in our company to handle these things. And it's never a good idea to wait till the last day of the year.
Yeah, very good. And yes, and I also got a lot of interest from folks about doing a dedicated webinar on the corporate defined benefit pension plans that we discussed there. So folks, I will get busy on setting one up. It's probably going to be earliest later in October, probably at some point in November, folks, just because we've got the conference coming up in just a couple of weeks here. All right, well, in wrapping up here, I meant to say this while you were talking, Mike. Given that gold is now really has been taken off, gold and silver for a good while now, I'm curious if anybody watching this video has experienced their own sort of shoe shine boy moment, right? Where normally those of us who invested in gold know that almost nobody owns it and nobody wants to talk about it. But we're now beginning to see more mainstream media articles beginning to cover gold and whatnot. And I'm just curious if folks are starting to hear in their lives regular people who they wouldn't normally think would be thinking about gold, all of a sudden beginning to talk about it. So if that's happening at all in your life, let me know in the comment section below. That'll be an interesting early indicator. All right, with that being said, let's start wrapping things up here. Folks, if you enjoyed having Michael Kantrowitz on and would like him to come back at the end of Q4 to give us his updated outlook for the start of the new year, please let him know that by hitting the like button and then clicking on the subscribe button below. As I mentioned, the conference for Thoughtful Money, the online fall conference, is coming up in just 3 weeks now. If you haven't got your ticket yet, get it for it fast. Go to thoughtfulmoney.com/conference. We are still offering our lowest early bird discount price for the conference, but it expires in a couple of days. So again, go to that URL, buy your ticket now. I want everybody to get the lowest price possible for the conference. Also, a reminder that if you're a premium subscriber to our Substack, I've emailed you a number of times now the code to use to get an additional $50 off of that lowest early bird price discount. So please use that discount when you buy. And lastly, if you would like to get some professional assistance in managing your portfolio for the road ahead, whether it unfolds the way that Mike Kantrowitz thinks it will, maybe whether some of the other curveballs that the guys at New Harbor think it could happen, or maybe something nobody else has envisioned yet, highly recommend you get that good professional advice from a good professional financial advisor, one who takes into account all the macro topics that we've talked about here in this video. If you don't have one who's doing that for you, then consider talking to one of the folks that Thoughtful Money endorses. These are the financial advisory firms you see with me on this channel every week. Perhaps you'd like even to talk to Mike and John there and their team there at New Harbor. So to set up one of those discussions, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out. These discussions are totally free. There's no commitment to work with the firms. It's just a service they offer to be as helpful as they can to as many people as possible. With that being said, John and Mike, another great week. Really appreciate you guys coming on. Very interesting times, fun time for those of us that have owned precious metals and have been fans of them for a long time, like you guys have. But as you said, Mike, nothing goes up forever. So we've got to be ready for the curveballs here as they happen. We look forward to you guys calling the balls and strikes for us here on a weekly basis.
So good to be here, Adam. We appreciate it, and we'll see you soon.
Thank you as always, Adam. We'll see you soon.
All right. And everybody else, thanks so much for watching.
In the next handful of months between now and the end of the year, silver is likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. To be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me.
Central bank and sovereign demand for silver is rising, supporting higher prices. While COMEX and LBMA delivery activity and ETF redemptions indicate big players are taking physical possession. Analysts view silver as undervalued versus gold and expect a breakout, targeting $60 to $70 by year-end, with potential $100 to $200 plus in a full monetary or credit stress scenario. Risks include unverified accumulation data and uncertain timing of delivery squeezes. Michael Oliver, CEO and founder of Momentum Structural Analysis, argues that measuring silver in dollar terms is almost meaningless. He sees silver potentially reaching $100 to $200 but takes it in stages, personally favoring silver miners over gold. Historically, silver has averaged around 2% of gold's price and even hit 3 to 3.5% in past bull markets, while today it sits at just 1.12%. With silver already up 42% this year versus gold's 37%, technical charts suggest an imminent breakout. Several well-known bullion commentators and dealers' voices like Andy, Bill Holter and Mike Maloney argue the market is now driven by huge physical demand, tightening supply and central bank sovereign buying, conditions that can push silver rapidly higher and make a $60 to $70 year-end print plausible. They point to record COMEX delivery interest, growing central bank interest in silver, and China's physical buying as the catalyst for an imminent breakout. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I think it's really relevant. Yeah, as I said, so many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years, and plot it. We have a graph we put in the latest report. 2%, meaning divide an ounce of silver into gold. Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Okay, still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, oh boy, you break through that and I'm going to blow the cork off this thing. The spread is about to do that, I think. And when it does, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals.
Michael Oliver warns that relying too much on fundamentals can mislead investors about timing, like the analysts in The Big Short who were early but not immediately proven right. In 2025, silver has risen 45% so far, hitting about $42 by mid-September. Rising industrial demand for EVs and solar panels, continuous supply shortages of about 800 million ounces since 2021, and growing central bank and investor accumulation through physical holdings and ETFs are the main drivers of its climb. Although supply is static and demand is dominated by China, silver's industrial role is expanding. Nevertheless, until prices compel attention, markets frequently overlook such truths. More significantly, silver has historically been used in conjunction with gold as money. Confidence will crumble as inflation reduces purchasing power and people lose faith in institutions, currencies, and central banks. This transition from optimism to anxiety could be brought on by a declining stock market. Major systemic changes, like the Federal Reserve's demise or income tax reform, are made possible under that setting. That unrest will help silver as an industrial metal and as currency. Let's shift our attention towards the interview.
Well, first off, I don't look at it that much, and I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. Mm-hmm. You could be right and not be right in terms of price reaction for 2 years, okay? You know, do you remember the movie The Big Short?
Yeah.
The guy, these 3 or 4 analysts around the country, different guys, didn't know each other, all came up with the same conclusion. There's going to be a mortgage crisis. There's no way around it. They pounded the table, okay? That was 2005, 2006. And it wasn't until late 2007 that the stock market finally topped. And it wasn't until 2008 finally that they said, I was right. So you get the point, fundamentals. Mm-hmm. Okay. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. Annual production of silver is not increasing. It's plateaued and demand is continually increasing. And by the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, which silver is essential. So anyway, that could become a factor where, let's say we cross 50 and CNBC needs an excuse to explain it, okay? And that's a good excuse. Oh, well, the industrial demand. Well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows, it has been. In fact, the U.S. has had silver as official money, too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt. where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. You suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. As I said, your grandfather, father, and you, house cost, loaf of bread price when I was a kid, it's 52 card pickup. And I think the stock market will be a big key in that. Why? Because right now, if you look at, let's say, the average guy who's got a retirement account, maybe it's through state government pension fund or whatever, if he looks at it nominally and it's been going up, because if it reflects the S&P, then it's been going up. Okay. Not a lot, by the way, over the last year, but, single-digit percent still. It's the only thing he's got to smile at. Everything else in his life is questionable. Cost of things are going up, et cetera, et cetera. And when that goes down, then it's, oh, hell, what's good? All you need then is some layoffs, et cetera, et cetera. And suddenly the average guy, instead of a sense of expectation, is a sense of doubt. And that creates fear. And when you create fear, the tone of markets change. And that's when institutions can get overthrown, ousted, abolished. And so it wouldn't surprise me that in a year or two there's no Federal Reserve. If the economy gets bad enough, which I suspect it will, there may not be any income tax, simply because it doesn't function. They go to a sales tax, etc. All kinds of things can change in big ways. I think that's the kind of situation we're facing now.
As trust in fiat currencies and institutions declines, there is a chance for sharp movements. How much higher may silver's price realistically rise in the upcoming years if it even recovers to 2 to 3% of gold's value? Will a decline in trust in central banks hasten the adoption of silver as a monetary asset and an industrial necessity? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
What percentage of gold backing the rest of the Fed's balance sheet would make the rest of the treasuries trustworthy to hold for people. And if we go to the 1980 numbers, it's something like $40,000 to $50,000. If we are to equate the dollar value of those 235 million ounces to the rest of the pile on the balance sheet, which is the monetary base, it would have to be 30 to, I think it's about 50,000, or it could be 55,000. It's somewhere around there, like between 40 and 50 or something like that. It doesn't really make a difference. But that's what we're talking about. I'm not talking about covering M2. I don't think we're going to get there because to cover M2 is what, like 21 trillion, whereas the monetary base is like 5.6 trillion. It had to be 4 times that. I don't think we're going to see $200,000 gold. I think the dollar's going to break before that.
In 1980, the market drove gold higher because investors no longer trusted the Fed's debt-heavy balance sheet. Gold rose enough to fully back that debt, restoring confidence. Applying the same logic today, with the Fed holding about 235 million ounces of gold against a $5.6 trillion monetary base, gold would need to reach roughly $40,000 to $50,000 an ounce. Covering the broader money supply would imply $200,000 gold. Rafi doubts it will reach that point, expecting the dollar to collapse first. Rafi Farber is a financial writer, investor, and commentator often referred to as the endgame investor. He explains that gold is real money, and when its price changes, it's not gold being revalued, it's the dollar. History shows 2 forms of revaluation: statutory, like in 1933 when FDR raised gold's price from $21 to $35, fueling inflation, and market-driven, like in 1980 when distrust in the Fed's balance sheet drove gold up to around $850. Both have the same effect, shifting the value of the dollar, just through different forces. A recent Federal Reserve analysis into gold revaluation mirrors a broader concern over the dollar's stability. While not signaling immediate policy action, it underscores the extent of fiscal stress. These discussions signal deeper doubts about the sustainability of fiat frameworks. Today, stresses in the dollar system are showing up again in the gold futures market, where spreads across maturities resemble those seen in the 2008 and 2020 crises. This suggests another monetary breakdown may be near. While the timeline is uncertain, the underlying truth remains: gold is money, and its role as the ultimate measure of value won't change no matter how the dollar performs. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
What it means that gold is the money. If the gold is the money, then every time the price of gold moves, it's revaluing the dollar. Gold doesn't actually get revalued. The dollar is being revalued. Now, the question is, are we talking about statutory revaluation or market-based revaluation? You just cited two examples, one being 1933, which was statutory, right? FDR just decided, maybe on some advisement, maybe on a whim. I remember I read when I was turning libertarian when I was younger, but he was talking about, I think in his book, Broke, how FDR just decided on a whim to make it 35. I don't know, he was just like flipping numbers in his head and he decided that was the one. Could be true, I don't know. And then you were talking about the revaluation in 1980, where the price of gold in the market that you could get a gold coin for to shop was what was being revalued, and that hit 872 or 850, wherever you want to count the top. And ultimately, these are really the same thing. Right? They're brought about in different ways. And that's, but they are monetarily speaking. What is happening in the monetary system? It's the same thing. It just the difference is who's acting upon it. Like if a 50-kilogram weight drops on your head, you're not going to really care that much if it was, like, say, a meteor from God, or let's say somebody had sinister would drop something on your head from 100 feet above you, or drop the piano on you. Either way, you're dead. It doesn't make a difference. So I don't think we're going to have a statutory gold revaluation. And what happens during a statutory gold revaluation? Well, you look at the price inflation statistics, which we have from the 1930s. And in April 1933, I think the deflationary, and I'm talking about consumer prices, the deflationary statistics were something like -9% a year. And then by about 10 to 12 months after the revaluation from 21 to 35, price inflation shot up to positive 10, 15% or something like that, like a huge move. And really that was the point, because by revaluing, that gave FDR's government, or the Fed under him or beside him or whatever, the ability to print more money based on that gold revaluation, and then the inflation came from there. If there are problems with the dollar, then what you would see is spot gold going pretty high relative to other maturities, but going out into the future, I think you would compress in the middle, and then the price would go higher out into the future, because you'd have speculators that are also worried about the dollar, because they want to, they're using gold to speculate because they see something wrong with the dollar. But also you have the people at the mouth of the pipe, the big banks, and they are going after spot gold itself. So you're having these like kind of zigzaggy, wavy maturity scheme. And I think that's what's happening now. But you'd have to look at a chart of this. It's available on Gold Charts or Us to see all the maturities and the different colors of the lines, and they get wider as we get closer to a crisis. So the chart goes back to, I think, 2005, 2006. The only time I've seen the maturities be this spread out are 2008, 2020, and now. So the question is it happening again? And there are other signs that corroborate it. How far out are we? I don't think we're very far. People say, like, I've been around since 2020 saying the same stuff, but it's 2025. Even 5 years is not that much time. I know that's kind of a cop-out, but it's also true, and gold is still money. I mean, it doesn't really matter, because I know what the truth is. People can say what they want, but the reality is reality. It's not going to change.
Rafi thinks that the financial system is like a giant pyramid with gold at the base and countless layers of debt and derivatives stacked on top. Nothing can replace this structure. According to BIS, proposals like the stablecoins can boost liquidity and payment efficiency, but they don't fix the financial system's core weaknesses. They only add another fragile layer. Their heavy reliance on U.S. Treasuries exposes markets to volatility, where sudden redemptions could spark liquidity shocks. Even with new rules like the Genius Act, critics argue regulation creates only an illusion of safety while deeper risks remain. Eventually, a crisis will force people holding stablecoins to convert them back into cash, triggering a rush for dollars. At that point, the Fed will have to step in and monetize debt as always, because the underlying pyramid hasn't gone away. These measures may provide short-term liquidity, but in reality, they make the structure even weaker, like stacking jello on top of bricks. One small shock, and the whole thing risks collapse. Now, let's review the interview.
No, it's not going to replace anything. All it's got, we're on a pyramid. The pyramid begins with gold, goes up derivative layer by derivative layer to where we are now. And there's a lot of derivative layers, and you can argue about what layer is which layer and where is it in the pyramid and all this stuff, and it's very complex. But there's no getting out of this pyramid without it either falling over or building a new layer that looks new, but it's really based on everything that's on before. Right? All you can do is build one more layer. So if they do this Genius Act and stable coins, and obviously there are serious threats to personal liberty involved with stable coins, fine. I don't dispute that at all. And I know that the government wants to take as much liberty as they can from us, reasonably, as much as they can reasonably get away with. They tried taking away almost all of it in COVID. There was backlash, and Trump got reelected. I'm really oversimplifying, I know, but I don't have time to get into geopolitics here or anything like that. But what the Stable Coin Act or the Genius Act, whatever they're calling it, can do is it can turn T-bills into a more liquid asset by making them tradable. If people are going to take stable coins as settlement for payment, then it turns T-bills into basically dollars. So the Fed wouldn't have to monetize that debt as quickly, theoretically. But sooner or later there's going to be a crisis anyway, and then everyone with stable coins is going to they're going to need cash, so they're going to have to sell out of their stable coins to get dollars, and there's going to be a rush on dollars, and then Fed's going to have to monetize it anyway because all of this pyramid is still there, and all prices from today are still based on yesterday. No matter what the hell you do, there's no getting out of that ever. Just like there's no breaking the law of gravity, you cannot fly without counteracting gravity with an opposite force pushing down. It's not possible. So at that time when suddenly there's a dollar crunch and everyone has to get out of their stable coins to pay their bills, right? Then the Fed's going to have to take those T-bills, turn them into dollars by buying the T-bills, giving dollars to whoever needs to give dollars to whoever has the stable coins. We're going to be in the same place we are now. So the most this can do is provide a little bit more liquidity on the top of the pyramid. But I guess an analogy would be like instead of like a really heavy brick on the top, right, on the top layer, you'd put, let's say, I don't know, something a little more jiggly, maybe like Jello on the top. So you can build it higher, but it's like a lot weaker, and like a little bit of sun can melt it, and then it just falls over anyway. That's the analogy that just came to my head. Jello.
History shows that whenever trust in the dollar erodes, gold steps in as the ultimate anchor of value. Whether through statutory moves like FDR's revaluation or market-driven surges like in 1980, the effect is the same. The dollar weakens, and gold reasserts its role as real money. Today's fragile financial pyramid, propped up by layers of debt and experiments like stablecoins, cannot escape this reality. As stresses build and liquidity games run their course, gold remains the foundation that cannot be replaced, only rediscovered when confidence in paper assets fades. If gold does climb toward $40,000 an ounce, how might this reshape global financial markets and investor behavior? Could stablecoins and digital assets delay a monetary crisis, or do they simply make the eventual collapse sharper? Please leave a remark in the section below with your ideas. Please remember to subscribe to receive updates, and if you find this helpful content, kindly give it a thumbs up. We are grateful that you joined us on this journey.
I think that the precious metals rally is saying that inflation was much higher than what the government was publishing in terms of CPI. The gold price is reflecting collapse in the purchasing power of money. And now the gold price is probably reflecting the cost of living increases between 1971 and today, rising strongly. So I wouldn't rule out that we could have gold and silver and platinum making short-term highs in the not too distant future. Gold would be a reasonable alternative.
The recent rally in precious metals like gold, silver, and platinum likely reflects much higher real inflation than official CPI figures suggest. Since the US left the gold standard in 1971, the purchasing power of the dollar has collapsed, and gold's rise is tracking the true increase in the cost of living over time. Ray Dalio says markets risk a hard attack from rising debt costs in the US and suggests holding 10 to 15% of one's portfolio in gold as protection. Moreover, Goldman Sachs warns of this scenario. The idea is that political interference could damage trust in traditional assets and the dollar, making gold more attractive. In the near term, new highs in metal prices are possible, and gold remains a strong long-term store of value. The speaker, Dr. Mark Faber, often called Dr. Doom, is a Swiss investor, economist, and market commentator. Gold's rise since the US left the gold standard in 1971 reflects the loss of money's purchasing power and higher living costs. Markets don't move in straight lines, they surge, correct, then resume upward. Over 10 years, gold would be a strong long-term choice compared to stocks or bonds. Gold is up nearly 40% this year, outperforming most assets as Fed rate cuts, a weaker dollar, central bank buying, and inflation fears drive demand. Forecasts put gold between $3,700 and $4,000 by mid-2026. Treasuries remain debated, with long bonds seen as fragile, while short bonds or cash offer optionality. Still, gold and miners are favored amid economic and policy risks. In downturns, gold is viewed as insurance. Mark Faber specifically mentions the mining stocks like Barrick and Newmont. Barrick is streamlining by selling non-core assets to focus on top gold and copper projects, though production and regulatory risks remain. Analysts view it as undervalued. Newmont has been upgraded to outperform for its turnaround, strong cash flow, and leverage to rising gold prices. Both miners are seen with significant upside, potentially doubling if gold's rally continues. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the video.
The gold price is reflecting the collapse in the purchasing power of money since the US abandoned or exited the gold windows in 1971, August 1971, when gold was at $35. And now the gold price is probably reflecting the cost of living increases between 1971 and today by rising strongly. That would be my view. But as you know, markets don't move in a linear fashion. They move up strongly, then they overshoot, then they correct for a few years, and then they resume their upward trend. So I wouldn't rule out that we could have gold and silver and platinum making short-term highs in the not too distant future. That I wouldn't rule out. And equally, you know, if you ask me, Mark, you have to go to jail for 10 years. It's always a possibility. And then you have to invest your assets in one asset class and only one asset class. You cannot diversify. So you can choose properties, or you can choose stocks, or you can choose bonds, or you can choose gold. And you have to choose this and leave it until 10 years hence, 10 years later, when you get out of jail and want to collect your assets. In that case, what would you invest in? In stocks, bonds? I mean, I think gold would be a reasonable alternative. I mean, I've never been terribly keen about mining companies, but starting, say, about 9 months ago, I wrote that for the first time I was rather positive about mining companies because they were incredibly low compared to the price of gold, which had gone up substantially. The mining stocks hadn't gone up, but this year the mining stocks rose substantially. And I still like mining companies. I want to explain to you why I like mining companies. I think if you look at Barrick or Newmont Mining, the stocks have gone up, but they're not meaningfully up compared to previous highs. So I'd say this is a sector in the market. You asked me about value in the market, what it was desirable. I think mining stocks are very desirable. I think Barrick and Newmont, they can easily go up another 100%. I think US Treasuries is an alternative, not ideal, but say relatively favorable. And then cash is not a desirable investment, but it may be better than other assets in a downturn. You understand? You're not going to make money.
And it gives you optionality. You have optionality in case you have opportunity.
Yes. But my sense is that if everything goes down, I tell you, it will be very difficult for you not to lose money. But let's say everything goes down 50%. Like in the Depression, it went down everything 80% or so. In that case, you're the king if your portfolio only drops 20%.
Mm-hmm.
You understand? The market assets go down 80%. And you are among the fortunate ones where the asset value drops 20%.
Mark Faber points out that the dollar stayed strong until late 2014, mainly due to capital inflows, not fundamentals. Trump's policies weakened global confidence in the U.S. Meanwhile, the U.S. is in recession despite official denials. Recent analysis highlights that inflation remains sticky, with real interest rates often negative and underlying price pressures not fully reflected in official CPI data. At the same time, a weakening dollar, growing doubts about central bank independence, and geopolitical risks are driving investors toward precious metals. Gold, silver, and platinum are increasingly seen not just as profit opportunities but as safe havens and long-term stores of value. Now, let's just reflect on the interview.
The dollar has been exceptionally strong until November 2024. And it has weakened since then. And if you say, or if you argue that it was in the cards that the dollar would decline, then I agree. The dollar has been strong, but not based on fundamentals. It's been based on capital flows. In other words, the world moved capital into US assets. And so the currency remains strong. But I think Trump has done a lot to destroy to destroy the confidence people had in America. The bond market in the US should rally because we're heading into a recession. I think we're already in a recession, but of course, Trump and his henchmen will argue, no, we are doing extremely well. And the economy is exceeding expectations, and so forth and so on. But the reality is that if you look at the living standards of ordinary people, they're not doing well. No way. And the wealthy people, including myself and so forth, we benefited from asset appreciation and did very well in the last 30, 40 years. Ordinary people that have no assets, they've been hurt because the cost of living is going up much more than their salaries. So ordinary people get squeezed. And ordinary people is 70% of the US economy. There are instances where when they cut rates, the market goes up, and there are instances where it goes down, depending on the expectations that preceded the interest rate cut. But in the present situation, a 25 basis point cut wouldn't do anything. That is expected. 50 basis points, I think the bond market would react favorably, but not hugely. I mean, my view is the bond market will go and sell and trade until the yield on the 10 years is between 3 and 3.5%. Because I think the economy is much, much weaker than what the Trump team pretends it to be. Most people aren't doing well economically. Now, is Jeff Bezos doing well economically? Yes. There, say, 500 people in the US that do exceedingly well. There are another 10,000 people that do relatively well. And then there are zillions that don't do well.
Do you agree with Dr. Faber that gold is the most reliable long-term store of value compared to stocks or bonds? Could mining stocks like Barrick and Newmont really double in value if gold continues its upward trend? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.